Hello, very good morning to all, and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here again. A very interesting movement across the global markets yesterday, which I'm going to share with you in greater detail for today's Daily Dose of Market Insights. So, very good morning to all. Today will be the Wednesday, the 13th of August 2025. So, as usual, before we jump straight into today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. Any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right. Okay, give me a minute. So hopefully the screen is good. All right, good. So let us kickstart yesterday's so-called. Give me a minute. I think there is some issue over here. Okay, let me do some adjustment to the voice. Give me a minute. Test 1 2 3. Mic test 1 2 3. Yeah, okay. Let's get started over here. There's a bit of noise over here because at my home outside there's this little buzzing sound. They are doing some grass cutting going on. So I try to actually do some filtering. Hopefully that's better right now. So yeah, where we are. Yeah. So before we kickstart the gist of the daily dose, which is as the intraday technical outlook on the four major US dollar pair, the 6 global stock indices, and the 2 key commodities market that we cover all this on a daily basis, i.e. which is Gold XAU/USD and the West Texas crude oil. Let's have a recap what has taken shape yesterday in terms of news flow, economic data release, and their impact on the intraday movement of all these broad-based cross-asset classes. So yesterday highlight was the release of that US CPI inflation data. Why is it important? Because that data is one of the metrics that the US Federal Reserve will guide its future forward-looking monetary policy. We call it stance, and we know that in the last few months, the US Federal Reserve has been on the stubborn side of the fence. That means, i.e., they decided to be much more data dependent, and with the chairman, US Federal Reserve Chairman Powell, refusing to actually move the pendulum and decide to actually stick on being data dependent and wait and see approach, despite the rest of the other central bankers has already cut interest rate or about to actually end their easing cycle. All right, so the Fed is actually being late in its interest rate cut cycle this time around. So let's take a look at what is the CPI data look like over here. All right, so let me share with you guys on my screen. Okay, so if you were to look at the CPI data, all right, so actually to me, it's more like a mixed data over here. So if you look at the headline inflation rate on a month-on-month basis, right? So that is actually including energy and commodity, including those commodities basket as well. That means energy and food. So they actually came in within expectation, and it came 1 basis point lower than the previous month of 0.3% month on month. All right. So for the July figure month on month, the headline inflation that is inclusive of energy and food components came in at 0.2% month on month, 1 basis point lower than 0.3% that was printed in June, and almost and on par with what market is expecting, 0.2% as well. And from if you stretch it out from the year-on-year basis, so year-on-year basis, they actually remove the seasonality factor over here. So this season removing of seasonality factor, it came in within the same rate at the previous month, 2.7% in the month of June, July 2.7%, but below expectation of 2.8%, which is a pretty, which in terms of for those wanting for the Fed to actually cut interest rate is a pretty good sign over here, because inflation on a month-on-month basis and a year-on-year basis is actually showing no sign of this potential pass-through from this ongoing US tariff regime over here. But if you were to look at, if we strip out the energy and food component, that means stripping out the commodities component over here, primarily focusing on the services side of the component. The services side of the component actually came in hotter than expected if you look at on a year-on-year basis. All right. So on a year-on-year basis, it came in at 3.1% year-on-year, above 2.9% that was printed in June, and also above what market is expecting at 3%. So if you were to look at the core inflation rate on a year-on-year basis, the trend, okay, it actually rose to a highest level since April last year. So there was actually since April this year. So it was the steepest in 5 months over here. All right, since February this year, pardon me, not April, since February this year. So actually rose. But if you look at from a month-on-month basis over here, it actually came in within expectation. So from the month-on-month basis, 0.3%, it came in within expectation of that 0.3%, slightly above the previous month print of 0.2%. So the net effect over here is that given this overall reading after being digested by market participants, there is at this moment in time, there is still no clear, we call it a signal that the ongoing US tariff regime has a material impact on the inflation data as presented yesterday. So what we could see over here is that this is what the market is looking at. Okay, so the pickup of the core inflation was fueled by services prices over here. So however, goods prices excluding food and energy commodities rose at a tame pace. All right, so market rejoiced on these good prices and sent the broad-based US stock market indices to fresh all-time high on the S&P and the Nasdaq 100. Why? Because that potential there could be additional liquidity that's being added into the market next month, where market participants continues to price in a dovish Fed pivot in September, which is the upcoming FOMC meeting. And bear in mind, still recall that since the start of this year, previously, market is looking for a first interest rate cut to come in May, and that has been pushed down the can because of that rather stubborn stance by Fed Chair Powell and some of the US Federal Reserve officials, saying that they are actually more data dependent. But given the fact that right now we start to see a weakening labor market after 2 weeks ago, the 1st of August, rather weak, disastrous non-farm payroll data, and right now we start to see rather mixed inflation data where the goods component doesn't show any signs of a tariff pass-through yet. So market participant now is looking for a very high chance of 94%. Market participants, I mean, is the Fed Funds futures traders that is trading in the Fed Funds futures market, has assigned a high probability of 94% that the Fed may cut in the next meeting, which is on the 17th of September, to bring the Fed funds rate down to 4% to 4.25%. And if you look at the aggregated tab, where we are also able to see what is the expectation like by the Fed funds futures traders for the next few monetary policy meeting over here, they also starts to assign a high chance that the next cut after September, 17th of September, will be on the 29th of October FOMC meeting, a rather high chance at 60% to bring down the Fed funds rate further to 3.75% to 4% over here. And what's interesting over here is that only 42% chance that the Fed will do a third cut before 2025 ends. All right, so that will be the 10th of December 2025 meeting. So far, market participants is assigning two interest rate cuts with high probability. First, coming in at the 17th of September meeting, FOMC meeting, to bring it down to 4% to 4.25%, that's 94%, and a rather high chance as well of 60% to bring it down lower again at 3.75% to 4%. So that's another 25 basis point cut on the 29th of October 2025. Then thereafter, 58% chance the Fed will stand pat after potentially the second cut of to come in the 29th of October 2025 meeting. So net overall is a dovish Fed pivot that market participants is expecting to come in on the 17th of September 2025 meeting. So because of this dovish Fed pivot, that sent the US stock market in a bullish frenzy yesterday. So we got to respect this bullish tone. Still remember that like I share with you in my daily dose of market insights, despite that so-called over concentration in AI team play, there is still no clear signs of a medium-term corrective move on the benchmark stock indices that we cover on a daily basis. That means, i.e., the S&P 500, the Nasdaq 100, and even the US Wall Street 30 that has been lagging behind the mega cap technology stocks, still evolving in a medium term and minor term bullish trend phases. All right. So yesterday, the SPX and the Nasdaq 100 scale up to fresh all-time high, led by those mega cap technology stocks, which is up. The SPX up by 1.1%, going above 6,400. The Nasdaq 100 up by 1.3% to a new all-time high, 23,839. Even the Dow Jones Industrial Average that lagged behind managed to rose 1.10%, and the top performer is the Russell 2000 in terms of percentage, up by 3%. So bear in mind that so far the Dow Jones and the Russell 2000 hasn't made fresh all-time high yet at this moment. So if you look at the concentration, the S&P heat map yesterday. So very clearly, those that are deeply in the green are the mega cap technology stocks by looking at the area of the carpet. So the bigger the shape represents, the bigger the market capitalization. All right, so those have a very small little triangle are very small in terms of market capitalization. So very significant, the mega cap technology stocks are deeply in the green, with the exception of Amazon and Tesla over here, which are Tesla is only positive 0.5%, Amazon almost unchanged, but the rest are deeply in the green. There's more than 1%, Google 1.25%, Meta Platform, parent company of Facebook, up 3.15%, Apple 1%, Microsoft 1.43%, Nvidia 0.6% over here. All right, so if you look at the 11 sector that make up of the S&P 500, all 11 of them are in the green, with the top three performer being the communication services, where Meta and Google and Apple, not Meta and Alphabet, which are key biggest component of the communication services sector. Then followed by basic materials, up by 1.5%, and industrials, which is pretty much positive, up by 1.5% as well, given the fact that the industrials has been lagging behind. But yesterday, it actually formed the top three performer over here. That also add to comfort that the Dow Jones Industrial Average will be soon to actually retest and break above that current all-time high that is still managed to hold ground since late December last year. All right, so later I'll touch more about the US Wall Street 30 short-term intraday technical outlook, which represents the Dow Jones Industrial Average. And also, given that highly anticipated Fed dovish pivot that is up and coming in the September FOMC meeting, that also causes the US dollar to actually plummet yesterday as well over here. So this is a 5-day rolling performance of the dollar against the major currency as of now as we are speaking. So we could see over here is that upon the release of the CPI data at this timing here over here, we see the dollar actually plummet. And right now, there's a bit of consolidation taking shape during the Asia session. So the dollar is the worst hit against the sterling, which is down by negative. The dollar is down against the sterling by negative 1.16% as we are based on the 5-day rolling performance basis. So if you were to look at the 1-day rolling performance, a shorter time scale over here, the dollar is still rather weaker as we are speaking right now, but the outlier is still the dollar yen, where there is some form of rebound taking shape on the dollar yen. So later we'll share with you the short-term intraday outlook on the dollar yen. And also what's interesting over here is that, like I mentioned, on the Aussie dollar, there's a key support level to watch on the 64.80, and price action indeed bounced right above the 64.80 after that initial Aussie dollar sell-off, triggered by RBA interest rate cut. So RBA cut interest rate yesterday. That has been more or less been penciled in fully by the market, where market is expecting 3.6%, a 25 basis point cut to bring the rate down to 3.6%. So that is the lowest level since April 2023. And during the press conference over here, RBA Bulot, which is the governor, signal a couple more cuts after yesterday's interest rate cut. But that, bear in mind, do not forget over here is that, in the FX market, everything is relative over here. So we also need to take into account what is the action of the US Federal Reserve going to be. And given the fact that market participants now is anticipating a Fed dovish pivot, so for sure, despite, yes, RBA is cutting rates as well, but because of this Fed dovish pivot that is coming into the forefront, that causes the Aussie dollar to find support at the 64.80 level and bounce back up to hit our resistance level at the 65.10, 65.30. So later I'll share with you more on the short-term intraday technical outlook on the Aussie dollar that came in within our expectation yesterday. Bullish bias still intact despite RBA guidance that they are going to cut rate furthermore after yesterday's third cut for this year. All right, over here. So then, what do I mean by the Fed dovish pivot that is coming into the market? So if you look at the US Treasury yield over here, let me expand my screen. Okay, so if you look at the 2-year Treasury yield, so this is a 2-year Treasury yield. So the 2-year Treasury yield is the most sensitive yield that is very, very in line with the so-called US Federal Reserve monetary policy stances. So what we could see over here is that it continues to trade below the 200-day moving average, and right now inching down to retest this year last year September low at the 3.55 level. All right, so yesterday it inched down lower by another 3 basis point to trade at 3.73%. And if you look at the 10-year over here, all right, so the 10-year was almost lackluster yesterday. All right, so yesterday almost unchanged. So what I could see over here is that the 2-year is now has a much more negative reaction than the 10-year Treasury yield. So indicating that number one, market participants is now more centered on a potential Fed dovish pivot near the horizon, which is in the potential upcoming September FOMC meeting. So that causes the 2-year Treasury yield to actually fall yesterday, where the 10-year remains intact. All right, and very clearly the 2-year Treasury yield is trading inching now much lower below that 200-day moving average and looking to retest last September low area at the 3.55%. All right, so this is the major support level. All right, previously also managed to help March 2023 sell off as well. So very clearly this is the major level. But what you could see over here is that the US Treasury has been trading in a series of lower high. All right, lower high since May 2024. All right, so this is a rather a bearish developing picture on the US 2-year Treasury yield, indicating that the market participants now are anticipating a dovish Fed pivot in the potential upcoming September FOMC meeting that caused the stock market to actually rose yesterday because more liquidity coming into the market picture, and also the US dollar to continue its bearish trend yesterday as well. So if you look at the US dollar index right now, is actually trading below the 20-day moving average after that earlier minor bounce that has taken shape on last Thursday, and now threatening to break below that 50-day moving average, okay, after the push up earlier on 28th of July. So this is also a rather bearish development from a technical perspective on the US dollar index that also support ongoing dollar weakness potentially as well. Right. So that's yeah. So one more particular news flow and share is more pertaining to this ongoing UX China tech rivalry. So we know that NVIDIA has been allowed by US or White House administration to sell the lower end H20 chips to China, because in terms of global sales, China still represents a significant share for NVIDIA, and due to these reasons, China national security concern right now, stating that NVIDIA H20 chips may have some kind of spyware that may detect China companies using that. So China urges their local firms to avoid, and not ban, only given an advisory to avoid NVIDIA H20 chips. So but by saying this particular statement over here, that could potentially boost local China related semiconductor stocks as well. So because of this potential boost of China semiconductor stocks, where the China top policymakers advise local Chinese firms to use China semiconductor, purchase China related semiconductor chips rather than NVIDIA chips, that actually created a feedback loop into the Hang Seng Tech Index. All right. So this Hang Seng Tech Index over here comprises of H shares that is listed on the Hong Kong stock market, but these H shares are more centered around the technology team play of the China. It could be Tencent platform company, and as well as SMC, SMIC, which is the China's semiconductor chip maker stocks as well. So they are actually up by 2.3% today. All right, due to that news flow that I shared with you, where the China top policy makers urges local Chinese firm to not to purchase NVIDIA H2 chips due to national security concern. And the rest of the Hang Seng indices also basking in the bullish limelight, up by 1.8% on the Hang Seng Tech. The HSCI, which is a broader H shares benchmark stock index listed on the Hong Kong Stock Exchange, up by 1.8%. The mainland CSI 300 A shares benchmark index up by 0.8%. And also the Nikkei 225 continues to actually scale fresh all-time high as well, up 1.36%. The rest of the other Asia Pacific stock indices also closed deeply in the green yet right now as we are speaking, due to this ongoing US dollar weakness. So the Kospi is up 0.83%, the TAIEX is up 0.82%, and our local STI is going to retest a fresh all-time high again, up by 1.08%. And there's a bit of profit taking going on in the ASX 200, down by negative 0.5% over here. So overall, it's rather a risk-on sentiment that is also being seen on the majority of the Asia Pacific stock indices, supported by a weaker US dollar as we are speaking right now. All right, so that sum up the first segment of today's daily dose. Now let me move on to the second segment, which is the intraday technical outlook segment. All right, so with that, let me expand my screen so that you guys can have a better view of the charts over here. So let's start with the FX market. All right, starting with the euro dollar. Right, so the euro dollar stage that rebound as expected, right exactly at our pivotal support at 115.90, bounce up, hit our first resistance zone at 116.80, 117.05 before it traded sideways throughout the entire US session and into today's Asia session as well. So I'll be watching very closely this 117.05 level, because previously it tested and it staged that minor pullback towards the 20-day and the 50-day moving average again before staging that bullish reversal after the release of yesterday's key risk event data, which is the US CPI data. So unless it has a clear breakout above 117.05, which is the hourly close above it, thereafter at the start of the European session, then I would tighten my short-term pivotal support level to the 20-day moving average over here, which also confluence with the former minor swing high of 12th of August yesterday before the release of the US CPI data now turns into a critical pullback support level to watch. That will be at 116.30 level. All right, so for now still remains the same 115.90. So unless we have a breakout above 117.05 in the European session thereafter, I will tighten my short-term pivotals. I will tighten my short-term pivotal support to 116.30. So next resistance level to watch after 117.05 will be 117.70 / 117.90, the 1.236 Fibo extension, and as 1.236 Fibo extension from this ongoing bullish impulsive up move sequence that is still intact since the low of 1st of August, and as well as confluencing with the minor swing high area of 24th of July and 28th of July. Above 117.90 takes us up higher to 1.1830, which is the minor swing high area of 1st of July. All right, and confluencing very closely to the next extension level at 1.382. However, a price action breakdown and a bearish reversal with an hourly close below 115.90, then that would invalidate today's bullish buyers tone and see another round of minor corrective decline sequence unfolding, exposing the next near-term support level, not area, at 115.20. So that's for the euro dollar. Next up will be the sterling dollar. So the sterling dollar now has hit our resistance level at 135.10 and also trading right above the 50-day moving average as well. So with the clearance above the 50-day moving average now, bullish momentum has really come back into the sterling dollar. So with that, I will have a tightened short-term pivotal support level for today at this minor congestion area here of 134.35 formally before the price action broke out after the release of the US CPI data. So for sure, that is a very important pullback support level in order for the bulls to hold again if there's a retest close to it, given yesterday key risk event and is after price reaction after that event over here. And in terms of the 1.3435. So 1.3435 will be my adjusted tighten pivotal support for the sterling dollar. Maintain my bullish bias of it. After 35.10, the next resistance level to watch will be 35.55, followed by 35.90 / 36.10, which is the minor swing high area of 24th of July, and as well as the 0.618 Fibo extension of this ongoing impulsive up move since the low of 1st of August. However, a price action breakdown below 34.35 that would negate today's bullish tone to see another round of minor corrective decline sequence developing, retesting the 20-day moving average, confluencing with the next intermediate support zone at 134 figure 133.80. So one price action hit 134 figure 133.80, I'll be on the lookout again for any bullish reversal signal on the bullish candlestick on a lower time frame to actually flip back to a bullish bias again, given that it's still trading above the 20-day moving average of the sterling dollar. So for right now, the key levels to watch: tighten short-term pivotal support level at 134.35, maintain my bullish bias for the sterling dollar. Next resistance level to watch on the near term on the intraday basis will be 35.55, 35.90, followed by 36.10. All right, next up will be the Australia dollar over here, going to the hourly time frame chart. So the Australia dollar managed to help exactly at the 64.80 level, hit our first resistance level at 165.40, 65.50 before shaping that minor pullback over here. All right, so with that, if you look at the hourly RSI as well, the hourly RSI also managed to pierce above this former descending trend line, now turns into a pullback support area and managed to bounce off right above the 50 level mark and hasn't hit the overbought level yet at this juncture. So indicating that short-term bullish momentum remains intact, but since that it hasn't broken above 65.50, I do not want to tighten my short-term pivotal support level to be so tight to be at this meeting area here, where there's a bullish Marubozu candlestick. Then after this bullish Marubozu candlestick, price action do two positive price movement upon the release of the non-farm upon the release of the US CPI data, and this is the meeting line of that this Marubozu candlestick. The close and on the open hour, similar at the open hour, didn't break below it. Then thereafter, you do see another successive price action move after the release of the US CPI data. So this is a very important short-term sentiment level for the bulls to monitor, which is at 65.04, which is very close to the 65 psychological level as well. So unless we have a clear bullish breakout above 65.50 with an hourly close above it, then I will tighten my short-term pivotal support level to 65.04. So for now, I still maintain the same levels in terms of the pivotal support level on the short-term basis for today, 64.80, maintaining my intraday bullish bias. After 65.50, the next resistance level to watch will be 65. After 65.50, pardon me, the next resistance to watch will be at 65.80, followed by 66.20, which is the 24th of July 2000 minor swing high. And if you do the Fibo extension right now, taking into account of yesterday's pullback before that bullish reversal take shape, okay, that will be coincide very closely to the 0.764 for the 65.80, and the 1.236 will be coincide very closely with the 66.20, right, making them as a rather magnetic level for the bulls to actually projected towards this potential upside levels to watch. However, if price action starts to move downwards and break below 64.80, today's bullish bias stance will be invalidated to see another round of choppy corrective decline sequence to float back down towards the lower limit of this expanding range support level. So it has been so far, if you look at the daily chart of the Australia dollar, since the low of 24th of April, it has been trading in this kind of expanding wedge configuration with the lower limit over here, right? So a break below 64.80 will allow a break below 64.80 on the Aussie dollar will invalidate today's bullish bias and allow it to float down towards the lower limit of this expanding wedge range configuration. Near-term support level to watch after 64.80 will be 64.50, followed by the all-important 1st of August minor swing low at 64.20. All right, so that's for the Aussie dollar. Still maintaining my bullish bias within this expanding wedge range configuration as it attempt to float into the upper limit of this expanding wedge range configuration using 64.80 as my short-term pivotal support for now, unless it has an hourly close above 65.50. 65.50, then I would tighten my short-term pivotal support to 65.04. All right, so that's for the Aussie dollar. All right, next up will be the choppy, frustrating dollar yen over here. So what we could see over here is that the dollar yen yesterday we flipped to a bullish stance, attempting to do the residual push up over here. So the residual push up almost hit our first resistance level at 14875 before price action broke down below the 20-day moving average, and right now it attempt to reintegrate back above it again at 14790. But the way the price action reintegrate, it actually very weak. Why? Because after this bullish breakout or reintegration back above the 20-day moving average, which is the 14790 level, there is no positive price action follow through after during the 10 a.m. mark to 11 a.m. mark Singapore time, and it formed a bearish shooting star or gravestone doji candlestick, what we could see over here. All right, and interestingly, if you look at the RSI, the RSI has broken below a parallel ascending trend line support previously in support over here. Okay, previously it was supported on 4th of August, and right now it's actually breaking down from this level, all right, this pullback area over here. So with such, okay, give me a minute now, let me draw a proper one. Yeah, it should be like this, yeah. Okay, taken from this swing low here. Okay, broken down from this parallel ascending trendline support and stage a bearish reaction right below it. So indicating the lack of upside momentum as well. So given this current intraday bearish movement on the dollar yen, I have very low conviction right now based on the current technical configuration for it to do that residual push up towards 14875, maximum 14950, which is the key conferencing with the key 200-day moving average. So now potentially it could actually float back down towards this minor range support area again at 14680 slash 14660 on a very short-term intraday basis. So with that, I'll be using this 14875 as my pivotal resistance for today. Okay, using 14875 as my short-term pivotal resistance level, flip back to a bearish bias on the dollar yen, low conviction now for a residual push-up. Next support level to watch on the intermediate term basis will be this minor range support that is still in place since 5th of August swing low, which is at 14680 slash 14660 for now. Okay, only a breakdown below 14660 will potentially lead us to a deeper intraday slide to retest the 24th of July 2025 low at 14585. Only a bullish breakout above 14875 will revive the residual push up to retest the key 200-day moving average at acting as the next intermediate resistance at 14950. So in a nutshell, if we were to look at the dollar yen on a daily chart, it still continues to be involved in this complex ascending range configuration since the low of 22nd of April, further being reinforced by the failure bullish breakout on on previous Thursday on the 31st of July, and after that rather strong bearish Marubozu bearish reaction candlestick from 1st of August, indicating that 31st of July was a failure bullish breakout as price action reintegrate back into this complex ascending range configuration since the low of 22nd of April. So i.e. what it means that since 22nd of April low, there is no clear directional trend on the dollar yen as it's going to be whipsaw around this ascending range configuration. Right, so that sum up the technical intraday outlook on the four major US dollar pair. So let us now focus our attention to the global stock indices, starting with the Hong Kong 33, which represents the Hang Seng index over here. So the Hong Kong 33 managed to stage that bullish breakout as expected, clear above our first resistance 25,220, and right now heading to our second resistance at 25,520. The hourly RSI continues to accelerate further on the upside after breaking above the parallel descending resistance line, indicating the start of a new impulsive bullish uptrend phase on the very minor time scale from the low of 1st of August as it continues to evolve within a medium-term uptrend phase within this medium-term ascending channel from 2nd of January 2025 low, and also within a multi-month major uptrend phase as it evolved in this turquoise green candle, which is this major ascending channel from the low of January 2024. Right, so that's close to about a year ago. All right, so right now, if you were to look at the hourly RSI over here, so the hourly RSI is now floating into the overbought area already. We hit the overbought area. So given that it's hitting the overbought area and coming very close to the resistance level that we highlighted yesterday, 25,520, there could be some form of a minor pullback taking shape afterwards in the later part of the Asia session, perhaps stretching into the US session as well. So minor pullback support level to watch will be my first resistance level, now turns into a pullback support level, which is at 25,220 over here. Then I will now tighten my short-term pivotal support level to this area here. Wait, sorry, where is it? Okay. This will be my Titan short-term pivotal support to hold in any minor pullback. Okay, got to react accordingly to the latest price action. So give me a minute, given that this is a short-term intraday technical outlook, not a longer-term multi-week or multi-month technical outlook. So I got to be more precise with my levels. More precise and a updated level according to the latest price action as we are speaking right now. Okay, so tidy up a bit. Okay, so now potentially our hourly RSI. What the hell? Where is it? Yeah, hourly RSI hitting the overbought region, but no bearish divergence. So there could be a potential minor pullback taking shape, given that the resistance now is coming very close at 25,520. So that's our upside resistance level, while we maintain our bullish bias since the start of this week. So upon hitting 25,520, there could be a minor pullback in terms of the way my expected price movement will be. And based on the Elliott wave perspective, that also is a minimum impulsive wave 3 target, which is the one-time extension from the low of 1st of August at 25,570, very close to 25,520. First pullback level to watch will be 25,220, maximum 25,055. So as long as this pullback didn't surpass below 25, as long as this risk of this minor pullback didn't surpass below Titan short-term pivotal support that I have today for 25,055, the next few moments of the Hong Kong 33 still remains on a bullish uptrend phase on the shorter term. The next resistance level to watch after 25,520 will be 25,750, which is the 1.236 Fibo extension taken from this low of 1st of August, and also very close to the former very close to the 24th of July minor swing high. All right, so if you look at the price action movement, that means this minor corrective pullback of 24th of July to 1st of August, this 1 week of minor corrective pullback of negative 5% is more or less game over. And now we are in the start of a new bullish impulsive upmove sequence. However, if we start to see a breakdown below 25,055, then this bullish upmove sequence will be in jeopardy, and price action may start to resume into a choppy minor corrective decline sequence, revisiting 24,915, maximum 24,790/24,725, which is the minor swing low that had managed to help on 6th of August and 12th of August this week. Right, so that's for the Hong Kong 33. Upward next will be the Japan 225, representing the Nikkei 225. So continue to scale fresh all-time high. And right now, he has already broken above our first resistance, now approaching our second resistance at 43,560, as indicated yesterday. So right now, what we are seeing now is in midst of a extended bullish impulsive wave 3. Wave 1, Wave 2, Wave 3, with the potential next resistance level to watch will be at the 3.618 extension, followed by the 4.236 extension, which is also confluence with other Fibo extension level as well, taken from different minor swing low. So 43,560 will above it exposes 44,050, 44,110 on the Japan 225, representing the Nikkei 225. So still maintaining our bullish impulsive up move bias for today. All right, so with a Titan short-term pivotal support level at 42,513, 42,460, which is also the former all-time high previously from July 2024, and also the former minor swing high that was being printed this Monday, 11th of August. Only a bearish breakdown below 42,460 will negate today's bullish bias tone to kickstart a deeper minor corrective decline sequence, exposing 41,975 followed by 41,610. So when price action re-hit this 41,975, 41,610 area, I will be on the lookout for bullish reversal candlestick pattern on the lower time frame to flip my bullish bias back again, given the fact that the Japan 225 is still trading within a minor and a medium-term uptrend phases. So that's for the Japan 225. Next up will be the Germany 30. So like I recall the Germany 30. Okay, let me delete this. Okay, let me put in the RSI for you guys. Right, so for the Germany 30, still recall on Monday, we are expecting the start of a new bullish impulsive up move sequence after that corrective decline phase more or less has ended from 10th of July to 1st of August. Slight over here as price action managed to stage a bounce off from the lower limit of this minor ascending channel that is still in play since 19th of June 2025 low, and price action managed to reintegrate back above the 50 and the 20-day moving average. And what we are seeing right now is also in line with our expectation so far, where the hourly RSI managed to actually stage a bullish breakout from a parallel descending trend line previously in place since when it hit overbought on 7th of August last Thursday, and yesterday it managed to stage above a bullish breakout of it over here. So indicating that bullish momentum has starts to return in the shorter time frame for the Germany 30, supporting our bullish bias outlook. As we stated since the start of this week, the Germany 30 may be likely in the midst of doing a fresh impulsive upleg, flash bullish impulsive upleg since the low of 1st of August. So still no change since price action can't break out above last Thursday minus swing high at 24,360. I do not want to tighten my short-term pivotal support to be so tight, still maintaining at 23,990 as the German 30 en route to retest last Thursday minus swing high at 24,360. Above it, potentially seek out the next intermediate resistance to watch on intraday basis at 24,560, which is the minus swing high area of 24th of July and 28th of July. Only a bearish breakdown below 23,990 will invalidate our bullish bias for today to see a corrective slide to expose 23,790. A breakdown below it may seek out a lower levels to watch will be at 23,600. So still maintaining my bullish bias stance for the Germany 30 given the positive observation that is being seen on the hourly RSI like I explained earlier, using 23,990 as my short-term pivotal support for today on the Germany 30. Next up will be the US Wall Street 30 representing the Dow Jones Industrial Average. So finally it managed to clear above the 20-day moving average. Previously that was acting as an intermediate resistance since 1st of August Friday over here after the bearish breakdown, but managed to survive right exactly at the 50-day moving average. So given that bullish breakout of that 20-day moving average over here, I would tighten my short-term pivotal support to higher level from yesterday minus swing low upon the release of that key US CPI data at 43,995. So using a adjusted short-term pivotal support at 43,995, still maintaining a bullish bias on the US Wall Street 30. Next two intermediate resistance level to watch on the intraday basis, 44,780, followed by the all-time high area at 45,100 that has yet to be broken out on the US Wall Street 30. So this 45,100 level, if you go to the daily time frame, is the previous all-time high that was printed in early December last year, right after the results of the US presidential election results. However, if price action starts to break down below 43,995, that would negate today's bullish tone to retest the 50-day moving average again at 43,750. So once upon hitting 43,750, I'll be on the lookout for any bullish reversal candlestick on a lower time frame because of that previous short bullish reversal that was seen after that initial sell-off on the 1st of August previously. All right, so given that there's a positive price action on the significant momentum previously tested on the 50-day moving average, hence I'll be on the lookout when it hit 43,750 again, looking for it to seek out any potential bullish reversal candlestick on the lower time frame. Right, so that's for the US Wall Street 30. Next up will be the S&P 500. So the S&P 500 managed to scale fresh all-time high, breaking above 6,430 level yesterday. So with this bullish breakout to scale fresh all-time high, the hourly RSI, yes, it hit the overbought level yesterday and managed to do a pullback, but so far there is no clear bearish divergence as price action on the hourly RSI continues to print a higher high in line with the raw price action on the S&P 500. So with that, I will still maintain a bullish bias in any potential pullback. So first pullback level to watch will be the former all-time high area now turns to the pullback support at 6,430. maximum will be the lower limit of this ongoing minor ascending channel that is still in place since 1st of August low, now acting as a critical short-term tighten pivotal support at 6,390. So still maintaining my bullish bias in any pullback with a tighten adjusted short-term pivotal support at 6,390 for the S&P 500. Next resistance level to watch will be 6,470, 6,490, followed by 6,515 level, which is the 1.618 Fibo extension from this ongoing bullish impulsive up move since the low of 1st of August, and so correspond to the upper limit of this ongoing minor ascending channel as well. Only a bearish breakdown below 6,390 will negate today's bullish bias to see corrective, to see the extension of the minor corrective decline to expose the 20-day moving average, confluencing with the next near-term support zone at 6,347, 6,330. So when once price action hit 6,347, 6,330, I'll be on the lookout for bullish reversal candlestick again on a lower time frame, given that it's still trading above the 20-day moving average, indicating that the short-term uptrend phase still remains intact on the S&P 500. Next up will be the Nasdaq 100. So Nasdaq 100 continues to burst up as well and cleared above the former all-time high at 23,710 that was printed out previously on 31st of July this year. So this level will turn into a pullback support level to watch. So very similar as well, the hourly RSI has not shaped a bearish divergence over here. So that could be a minor pullback taking shape at the start of the US session today. So I will be still maintaining my bullish bias stance in any minor pullback. First support level to watch 23,710 with a tighten short-term pivotal support level for today at the lower limit of this ongoing minor ascending channel from the low of 1st of still in play from the low of 1st of August this year, now at 23,490. Still maintaining my bullish bias stance with a tighten adjusted pivotal support at 23,490. Next two resistance level to watch will be 24,020, followed by 24,185, 24,240, which correspond to the upper limit of this medium-term ascending channel from the low of May 2025, and also a Fibo extension level as well. However, a price action breakdown below 23,490 will see an extension of the minor corrective decline to retest the rising 20-day moving average that now confluence with this next near-term support level at 23,295. So similar with the S&P as well. Once it hit the 23,295 thereabout, I'll be on the lookout for a bullish reversal candlestick pattern on the lower time frame, because the short-term uptrend phase of the Nasdaq 100 still remains intact at that juncture. Right, so that sum up all the intraday technical outlook on these 6 global stock indices. Let us now move our attention or shift our attention to the commodities market, starting with the gold XAU/USD. So gold XAU/USD managed to actually help right exactly at our pivotal support, which is 3,334, and managed to stage a bounce, but that bounce was not rather lackluster. It didn't actually do any so-called break above the 20-day moving average. It's just rather sideways after that. So given this lackluster move on gold XAU/USD yesterday after that reaction off from the pivotal support level, so given the lackluster movement, my conviction is not so strong right now to maintain my bullish bias stance to allow it to float back to the upper limit of this medium-term sideways range that is still in place since its current all-time high of 22nd of April. So it has been trading in the medium-term sideways range for the past 3 months plus over here. So given this lackluster movement after the reaction of the pivotal support of yesterday at 3,334, so for today I will have a neutrality stance instead. So it's more like a sideways movement on gold XAU/USD for now. Okay, so neutral between 3,334 and the 20-day moving average over here, acting as a next intermediate resistance at 33,360. 3,360. Okay, 33,360. Okay, so neutral between 33.60 and 33.34 for gold XAU/USD, as explained earlier, because price action doesn't seem to have a positive reaction after the test of yesterday's short-term pivotal support at 3,334. So only we have a clear breakout with an hourly close above 33.60, then I would reinstate my bullish bias again for it to float back up towards the upper limit of that medium-term range configuration, with the next support zone support, next resistance level to watch 3,383, followed by 3,402 level. Okay, 3,383 followed by 3,402, where price action come breakout since last Friday. Right, so that's for gold XAU/USD. Flipping to a neutrality stance for today for between 3,360 and 3,334. Onward next will be the West Texas crude oil. So the West Texas crude oil continues to tumble down and now heading towards our first support level at 62.50, followed by 61.30. So far, there is no bullish divergence that's being seen on the hourly RSI over here, as the hourly RSI continues to trade a series of lower low. Whoops. Come on. Okay, trade the series of lower low over here. All right, so with that, indicating that downside momentum still remains intact for the West Texas crude oil. So with that, I will have a tightened short-term pivotal support to be very close to the minor swing high area of 8th of August, swing high of 11th of August, and 12th of August, where price action got rejected right exactly at this level before inching down much lower. Right, so tighten it up to this level here. Oops, sorry. What is it? Okay, let me tidy up. Copy, paste. Okay, this level will be 64.85. 64.85 over here. So I'll have a tightened short-term pivotal resistance level for West Texas crude oil to maintain this ongoing bearish impulsive down move sequence over here. So as long as tightened adjusted short-term pivotal resistance is not surpassed to the upside today at 64.85, the next two support levels to watch in the near term as price action going to inch down lower, potentially 62.50 followed by 61.30, which is the former gap up support level from 30th of May. However, if price action managed to break out above 65.85, today bearish bias tone will be negated to retest 65.60. Above 65.60 may see a mean reversion rebound scenario unfolding much higher towards 67.40, which is the 50% Fibo retracement of this ongoing bearish impulsive down move from the high of 31st of July all the way down to the current last Friday minor swing low that has yet to be taken out at this juncture as we are speaking. So that's for the West Texas crude oil, maintaining that bearish bias with a tightened short-term pivotal resistance at 64.85 for today. And that also sum up the intraday technical outlook on all the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So for today will be Wednesday. So this coming Wednesday, over at the European session, will be a rather quiet session as well. Then thereafter, we have Federal Reserve official speaking, 7:30 p.m. Fed banking, followed by the weekly EIA crude oil stockpile change at 10:30 p.m. So that will potentially influence the West Texas crude oil prices on the intraday basis. Then we have Federal Reserve official speaking at 1 a.m. Singapore time, Fed GUSPI. Then followed by early Asia session before the start of our daily dose at 11 a.m. At 9:30 a.m. we have a key Australia labor data, which is the employment change and the unemployment rate out at 9:30 a.m. that could influence the Aussie dollar and the Aussie crosses, and as well as the Australia 200 index. So with that, we also have something to look out for those who have interest in the Hong Kong 33 index, because for today at the close of the Hong Kong stock market, you have one mega cap China technology stock reporting is Q2 earnings, which is Tencent Holdings, that could impact the movement of the Hang Seng Index, which is the Hong Kong 33 CFD index in our platform. So that will be today. after the close of the Hong Kong stock market session. All right, so with that, let's sum up today's Daily Dose of Market Insights. I'm Kelvin here signing off. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.